name is Karim Ghalayini, Vice President at Horizons ETFs. Let's talk about commodity exchange traded funds, or ETFs. First off, what are commodities? Commodities are raw materials, like crude oil, natural gas, and uranium, as well as metals that underpin global wealth, like gold and silver. There are also agricultural commodities, like wheat and soybeans as well. As natural resources, commodities have investable value. Like other asset classes, the value of a commodity can increase or decline based on factors like supply and demand. Investors looking for portfolio diversification, a hedge against inflation, or who have a strong belief in the outlook of a natural resource can consider commodities. So how can you invest in commodities? There are a few ways. You can get indirect exposure by investing in a commodity-producing company. Or you can invest directly, either by physically buying and storing the commodity or investing in a futures contract for that commodity. Investing indirectly in a commodity producer could potentially expose you to the particular risks associated with that company and prove to be a poor proxy for the commodity. On the other hand, buying and storing barrels of oil might prove to be a cumbersome approach, while trading individual futures contracts could be too complex for many investors. That's where ETFs come in. Commodity ETFs remove the responsibility of holding a particular commodity in physical storage or managing its exposure through investments in futures contracts, while still allowing them to reap the potential benefits of the asset class. For example, a physical storage commodity ETF offering exposure to gold could have its value tied to gold bullion stored within a bank vault, while a futures-based commodity gold ETF would provide exposure to the price of gold through futures contracts. For futures-based commodity ETFs, the more prevalent type of commodity ETFs, futures contracts are rolled from a specific delivery month to a subsequent month before contract maturity, when the holder of the contract would be required to accept or deliver a physical commodity. That way, the ETF can provide exposure to the price of the commodity without the added cost of storage and maintenance. Futures-based commodity ETFs can be impacted by conditions called contango and backwardation, which describe the relationship between the forward price of the futures contract and the spot price of the commodity. Contango is a condition in which the price of a futures contract is trading above the expected spot price at contract maturity, and the futures curve is upward sloping. In a contango environment, an investor may experience negative roll yield, where even if the commodity appreciates as predicted by the futures curve at the time of the investment, the investor holding long futures may not gain accordingly. Backwardation is the inverse of contango, in which the price of a futures contract is trading below the expected spot price at the contract maturity, and the futures curve is downward sloping. In backwardation environment, investors may experience positive roll yield, where even if the commodity declines, as predicted by the futures curve at the time of the investment, the investor holding long futures may experience no loss. If you're looking to invest in a particular commodity, it's worth considering using an ETF. ETFs can make investing in commodities easier by removing the need to trade individual futures contracts and the need to physically hold or receive delivery of the commodity. ETFs are also liquid, meaning you can buy or sell your commodity ETF throughout the trading day, allowing investors to take advantage of intraday movements. Whether you're interested in investing in commodities like oil, natural gas, gold, silver, or much more, Canada's ETF universe has you covered.